100 or so is what we have. Rajesh Bhatia is Chief Investment Officer at ITI AMC. Rajesh, good afternoon. Good to have you with us here. I think you've been a little cautious at the margin. Markets have been anything but cautious. They've moved on, and once in a while you get a 100, 150 odd point cut, and the chatter starts whether this is the start of something or the market is going sideways. So I don't know if that today is one of those days, but broadly the markets have been very constructive. So briefly, if you can circle your thoughts on where we are in the markets, and then we want to ask some sector-specific questions to you. Go on.
So, Prashant, you're absolutely right. I mean, it's remarkable how strong the market has been. In fact, we are also observing the markets. It's a bull market, and we are also observing the markets. What we do observe at this moment is that there is certainly a level of churn that is happening. I think there is a fairly consistent weakness in public sector enterprises, defense. Some of the popular categories like defense, etc., have also been been a little weak, capital goods to some extent, etc. And there is enormous strength in IT, pharmaceuticals, and consumer names. So there is some bit of churn that is happening, but at the index level, everything is really reasonably strong. I think a lot of the trepidation or the fears are really coming from the global markets. I think people are concluding, and they were always worried that China is really a structural growth challenge, but now that is slowing down, which was really the only developed market which was really strong, but it's also slowing down, and therefore the world slows down. And because of this, some of the commodity prices come off. You look at iron ore, you look at oil prices, and people start to conclude, my God, if this is going to be a slowdown, India is also going to get impacted by the global growth slowdown. So I think there is some kind of churn that is taking place to defensives. Some of the popular categories are moving down. There is global fears, but my sense is at the index level, we are still very, very, very strong.
The mid-cap index is selling off pretty rapidly now, down 150 points in the mid-cap index, 0.25% lower, and Brent crude prices, by the way, have bounced a bit. So in the morning, it was $69.50 per barrel. Now we're approaching 70.75 on Brent crude prices. Rajesh, do stay on. There's an important story that we want to talk about, where sources...
Well, thanks so much for tuning in to CNBC TV18. Make sure you follow us and stay updated on all our social media platforms.
This new scheme, and there is a name change too. Rajesh, Ola Electric, or would you go with some legacy players? Are you bullish on this EV opportunity for two-wheelers?
So I'm bullish on the electric vehicle opportunity because I think the understanding is that over a period of time, the cost of electric vehicles will come down. And over a period of time, the cost of IC engines actually will drop. So, EVs over a long period of time are definitely going to become more attractive. And I think that's a global conclusion right now. I just read today that Honda is also going to launch its own two-wheeler EV. It's probably the last one to announce among the major players that it wants to get into an electric vehicle. Now, like as Bill Gates says, sometimes we overestimate the technology penetration in the short term, but underestimate it in the long term. So my sense is that probably we are overestimating how much electric vehicles could be absorbed in the short term. Look, even the two-wheeler space, where it's the maximum, it's only 7% of the total market. And my bet, if you are asking me, is still with the incumbents, because there's a lot of deliverables that the challengers have to yet deliver on. So my sense is that given how the existing players, incumbents have done, I think I would really back the incumbents rather than the challengers.
Okay, all right. Rajesh, stay with us. I wanted your view. Rajesh, I wanted your view. Every now and then, since I track cement as a beat, suddenly you have this spurt in, some of these stocks. We had a big move in Novoco earlier when the stock went about and everyone said it's getting bought out. Then you had Orient. Now you have Prism that's doing the rounds. And to be fair to the street, actually a couple of deals did get closed out. So it's not wrong being optimistic. But how are you all placed on this space? Cement, tiles, bathware, etc.
So specifically on the cement sector, look, this has been a phenomenal sector in the last 20, 30 years. I hardly remember any year in which cement would have experienced a negative volume growth. There are many wealth creators in this category. right? I mean, I don't have to name them, but look at the list of companies that are there in the cement business, and you'll see them compounding as good as some other paints companies have compounded at. Having said that, there is a bit of a challenge now with the sector. Earlier, there used to be downturns where people used to exit the business, but the downturns in this business have totally gone away. And if you look at the last 10 years, the EBITDA per tons have ranged between 800 to 1200 rupees a ton. The logic was that EBITDA per ton should go up as the capital cost of putting up a cement capacity is rising. But that has not happened. The result, your profit growth for the last 10 years for most cement companies is 10% per annum. And even today, we are looking at an overcapacity and probably about a 75%, 78% capacity utilization. So I think the industry structure itself is such that you can just get nominal growth. Of course, you can have an asset-based valuation where some of the stocks have done well. But in terms of earnings growth, the last 10 years have been very tepid, and I'm not expecting blowouts, as you move forward like that.
Okay, got it. Rajesh, to sort of go back to the first point, you said some of the popular segments have taken a backseat, railways and defense and PSUs, etc. So has a new leader been anointed, or that is still pending? And where will money be made?
So it's work in progress. There is IT, pharma, and consumer, but I don't think they are available at very cheap prices either. They're also at reasonably priced to probably slightly expensive valuations. But probably this is a path. This is a bull market. So this is a path where probably money, which is still in the system, is going to more defensive sectors. So my sense is that what is the best thing that you can do? Stay invested. See, this is a bull market. Is there a reason why you are getting, you can get a more than a 20% correction in the market, which is a bear market? We don't see any reason where you can get a 20% correction. Can you get a 5 or 10% correction, which is a correction? That is quite possible. So I don't think there is any reason why you can get a very big correction in this market, because of which, in a bull market, just stay invested. India is a great story. You may probably suffer a 5 or 10% decline, but on a multi-year basis, I think India is the place to be.
And on banks, Rajesh, banks have tested the patience of investors. Despite everything working for them, they just haven't performed. Rajesh?
Rajesh, we can see you, Rajesh. We wanted your comment on the banking names. I think you have a preference out there. It's, I think, private versus PSU. So tell us more.
So my sense is that the PSU basket did extremely well, as the credit costs, etc., came off and interest rates rose. The economics or the ROEs gravitated closer to the private sector banks. But my sense is that valuation discount, which was there, has also now gravitated towards the private sector banks. So because of which, my sense is that the discount is no longer available in public sector banks. They are far more leveraged than the private sector banks, and their ROAs are structurally lower than the private sector banks. So our preference has moved from public sector banks to private sector banks.
All right, Rajesh, we leave it there. Thank you very much for your time. Appreciate you joining in with your thoughts and perspective. Appreciate it. Well, we'll take a quick...
Well, thanks so much for tuning in to CNBC TV18. Make sure you follow us and stay updated on all our social media platforms.